Hi, who just joined?
Hi. Hi, Nitin. This is Karen. Hello there. How are you?
I'm doing good. How are you?
Fine too. Thanks for asking. Are you excited for the webinar?
What's that?
I was just asking if you're excited for the webinar.
It's my first time doing it, so let's see how it goes.
Sure. Yeah. You should do great for sure.
All right, thank you so much.
Can you hear me well though? Like, is there a static on the line? Because I'm having issues with my headset. Not sure why, but just wanted to check.
It's cutting a little bit. I think
okay.
cutting a little bit, but you're okay.
Thank you.
You're welcome.
I'm here. Can you guys see my beautiful, handsome face?
Yeah.
How you doing, Sharad?
Hello, Swami. How are you?
You hear me?
I can hear you, Swami.
Yeah, good to see you.
Hey, Swami, how are you?
Hey, doing well, man.
Thank you for joining the call, Swami.
Yeah, thank you. My hair's not as nice as your guys' hair. Apologize. It's getting longer.
You look rough and tough, Swami. Hey, go on.
there's no barbers around. What are you gonna do?
Yeah.
Exactly. That's my dilemma.
Yeah.
That's what women like, rough and tough, no?
Yeah. Exactly.
By the way, I have Karen also on the call, Swami. She's my assistant.
Okay,
Karen?
nice. Hey, Karen, nice to see you.
Hi. Nice to see you too.
Nice to meet you finally. I got your emails.
All right.
Do you have your video on, Karen?
Yeah. Let me just try to. I'm just fixing something here, Sharad. Just. Buti ka kung background lang ilang mga background lagi kay tintal akong background.
Put yourself on mute, Karen.
Yeah, sorry.
Hello, Bhanu. How are you? Bhanu, can you hear me?
Yeah, I can hear you. Hello.
Hello, Bhanu. Thank you for joining our meeting today. And we hope to bring value to your time, Bhanu.
Yeah, thank you.
So people start rolling in at like a couple of minutes past 1. So we'll just give them a few minutes.
Okay.
And I'm also recording the call, just FYI.
Okay.
So be at your best.
It's not Indian Standard Time. Everyone's on time. This is nuts.
Yeah.
We are taking it to the next level, I guess.
Yeah, good.
It's not the same level anymore. What happened to the weather today, Sharad?
Weather, I don't know.
So cold outside.
Yeah, last couple of days have been a little cold.
Yeah.
Which part of the country are you from, Bhanu?
I'm based in Austin, Texas, the hottest market right now.
Wonderful. How's the weather there?
It's really good today. Yesterday was a bit rainy, but yeah, today is bright.
Great.
Where are you all based from?
So I am from Bay Area, California.
Mm-hmm.
Nitin is from Bay Area.
Okay.
Let me see if I can play something for the time being for.
I actually been to Texas, San Antonio. My brother-in-law is active duty Air Force. It's
Oh,
fun.
nice.
Yeah. I was there for a week in, I think 2017.
Hmm.
Yeah.
Yeah, in 40 minutes, we have this airfare where like 6 flights will be flying from Austin to San Antonio, I guess, for the coronavirus doctors, just to appreciate them.
Oh, wow. Okay. Nice.
Can you guys see my screen?
Yeah.
Let me play something for people's amusement or in the meantime. I think we have few other people.
Hey, Carlos, how are you? We have few other people on the call. We have Ashima Dua. Hello, Ashima. We have Bhanu on the call. Hello, Bhanu. We have Nirav on the call. Hello, Nirav. We have Prashant on the call. Hello, Prashant.
Yeah, hello. How are you doing today?
Good, sir. Thank you so much for taking time, joining our webinar. And we all hope that we are going to bring tremendous value to all of you guys' time. We are going to give a few more minutes for other people to join, and then we'll get started. So just hang on tight for us for a few more moments, please. And let me see if I can keep you guys entertained in the meantime.
Sure.
I'll play the last video and then we'll start our today's seminar. And this one I'll tie in to our topic today. So we'll have a good start to the session. All right. So let's get started, and other people can join in as and when get their time. So thank you so much for everybody to join the call. This is Sharad, and you guys might have joined one of my previous sessions where we talked about the recession around COVID-19 and what is happening in the real estate market. This session, I decided to invite somebody from lending. He works for Golden Credit Union. His name is Nitin Khanna. And we thought that we'll take a little bit peek into around the lending scenarios and around money, because no money means no real estate. And smart people really knows how to use other people's money to get into real estate. And I thought this might be a great session to bring in front of you guys. So with that, I'll leave it up to Nitin. And Nitin, can you please briefly introduce yourself? And let's start with what you have on the table, and then we'll take some questions. Some questions I already got from people. They sent me over email, so I'll ask them as and when I get time. And then everybody else on the call, feel free to unmute yourself and chip in and ask questions. We keep this session very, very interactive. The more interactive it is, the more questions you ask, the better we'll be able to help you out. So do not feel shy. And if you have anything personal to ask, you can send me a chat message, and I can ask it on your behalf and keep your identity secret. So feel free to jump in, and let's make it interactive. With that, I'll hand it over to you, Nitin. Nitin, we can't hear you. You have to unmute yourself.
Sorry,
Yes.
I'm so sorry. I'm sorry. Can you
No
hear me
problem.
now?
We can hear you now. Go ahead, Nitin.
Awesome. Thank you so much, Sharad, for having me here. I really appreciate it. So again, my name is Nitin Khanna. I am the home loan advisor for Golden One Credit Union here in the Bay Area. I have been in the industry for quite a few years in finance. Originally, I am from India, migrated in 1995. So ever since I graduated in 2001, I've been in banking and just doing the lending part of the mortgage. So with that said, market is good. Rates are definitely at their lowest peak right now. Whether you look at the refinancing part of it or a new purchase part of it. Today, the market is a little bit down. It's about 500 points down. So you will definitely see some some changes on the interest rates as well. But overall, it's crazy busy for lenders, especially for me, our lender. We are crazy busy. So today, what I decided was, I can go over, like Sharad said, quite a few questions, and then I wanted to morely talk about for new purchases where some borrowers have questions regards to what should be my credit score, how much I should be paying down, this COVID-19 of how is it affecting the market overall. I'm so sorry about this. Sorry guys, sorry about that. My phone was ringing. With that said, so feel free to ask me questions. I can go over my pipeline and all of the stuff that I do as a lender. The market has definitely changed over the past 2 months. As far as the interest rates goes, they are the lowest in the market right now. The market has been affected quite a bit by this COVID-19. So that's where I stand, as a lender. So what do you think, Sharad? What type of questions or what do you think about the market right now as far as the real estate goes, and how is it impacting?
Absolutely, absolutely. And do anybody have any questions on the phone for now, or I can have few questions which I have been getting from customers lately? Anybody on the call want to chip in first?
I'm just curious, Nitin, about, do you think the interest rates will go down, or do you think this is going to be the lowest for a while?
Well, that's a good question. 2 months ago, if you would have called me at the lowest, I was basically locking in at 2.75 30-year fixed. I have never seen this. Interest rate will go down? Yes, absolutely.
Got it.
It's not going to go down as lowest that, whoever locked in 2 months ago. But if you look at the 10-year history, interest rates are the lowest at its best right now. It's just the time when you lock in.
Got it.
Right now, lenders have increased the rates purposely because they have so much in pipeline. They have to service those. Due to the whole COVID-19, you can see people are working from home. And sometimes it's very easy to work from home. Sometimes it becomes very hard. So they're all factors into it. But interest rates definitely will be affected, I would say, in about 30 to 40 days from now.
Got it.
Definitely.
And I think I can add something on top of that, Nitin, from the real estate side, Swami. What we are seeing, at least what I am seeing, is a side effect of this entire work from home. Couple of side effects. People who had never thought that their home was small.
Yeah.
Exactly.
Everybody is staying on their home for a whole 24 hours. People have been calling me, hey, Sharad, you know what? I suddenly feel my home is smaller. Can you upgrade me to a bigger home? You know what? So that's one side effect. And the second side effect is more and more people have started thinking that working from home is going to be a new norm forward from here. So borrowers or people who were renting their homes and who were not really thinking of buying their homes because either they couldn't break into the market or because of the commute reasons, they are more open to purchasing homes now because they know they can buy a home probably a little bit farther, probably within suburbs, because working from home is going to be a new norm.
Yeah, that's
So
a
as
great
a side
idea,
effect,
actually.
yeah,
That's a
as a side effect,
genius idea. You can work. You can live now further away.
Yeah. So we are seeing more demand in the market from buyers, and it's coming as a side effect of COVID-19. So I was very surprised when I get so many questions from people every day.
Awesome. I'm taking notes, by the way, so just want to let you know.
Absolutely. And Karen, you can start with the first question, which one of our homies participants sent.
Yeah. So we got a question here, Nitin. What is the difference between system-generated pre-approval and upfront pre-approval or pre-qualification, Nitin?
Okay. Well, there's a huge difference. Let's talk about pre-qualification. So a lot of consumers have in mind that if I have a pre-qualification, I should not have any problems. I can go ahead and go in the market and purchase a home. There's a huge difference. Pre-qualification is generally when you go to your loan officer and you say, I make this much, this should be my credit, here's my assets. So what loan officer is doing is basically just verbally taking their word and putting it in the system and giving you a pre-qualification. So we have not verified your income, we have not verified your credit, neither we have verified your assets, right? So that's pre-qualification.
Mhm.
Pre-approval is basically also system generated, where you actually put in the income, put in the credit, and you run something called our internal jargon, which is a DU, desktop underwriting, right? So loan officer actually collects the documents, puts in the figures in the system, runs the underwriting automatically, and it gives a pre-approval. That is basically our more common nowadays, to run the credit first in order to get the pre-approval. And it's underwritten by the system. So now there's another thing that you just mentioned about upfront pre-approval. That is basically one step more on top of the pre-approval. So what I do is, if you really need an upfront pre-approval, what that does, and I'm going to ask Sharad as well, I think it's going to work for him too. It gives the buyers more confident when they are in the market, when they have something called upfront pre-approval, okay? Where the loan officer, like me, have verified their income, I've ran their credit, I've ran the system generated desktop underwriting, right? And I got the approval. Now I take a step further and send the file to the underwriter before even they get into a contract. So let's say, Sharad, you have a buyer. Let's say they are on H-1B visa. Their visa, let's say, expiring in 18 months instead of 2 years. So now they just want to make sure, hey, Nathan, I just want to make sure this loan's going to go through. So what I will do is I will take their information, scan it over to my underwriter, send the file, prepare file like we are in contract. It's called our TBD process, to be determined. So we don't know the address that the customer is going to buy. We just want to see if they can qualify for the loan. Underwriter actually verifies their asset, income, and credit, and underwrites the file as conditional loan approval. So that's what I offer as an upfront pre-approval within 48 hours. So that way, Sharad and his customer can be much more confident, 99%, okay, we already got the conditional approval, let's go ahead and get into a contract because I don't see any hiccups on the loan. If that makes any sense.
Oh, absolutely, Nitin,
Right.
absolutely. And the way I sort of try to explain it with an analogy that, let us say you go to Safeway, right, to buy a carton of milk, for example.
Right.
You won't go to Safeway without having money in your pocket.
There you go.
Either you need cash in your pocket or you need a credit card. You got to have money, otherwise you're not going to get milk, right? So it's the same thing in real estate. When you go out to buy a home, you got to have money, either cash in your pocket or in the form of a pre-approval letter, which the way I look at it, it's form of a credit card,
right,
which somebody has given you and told you that when you go out in the market to buy a home, this is the pre-approval letter, this is the credit card, and you can use money out of it. That's how I look at pre-approval, right? To answer your question, absolutely. When you bring pre-approvals in place, it's just like going to shopping with having money in your pocket.
Right. And you know what, sir? A lot of the lenders don't do that because it requires time for the underwriter to actually take a look at the file. Typically, it takes about 2.5 hours for right? It typically takes 2.5 hours to underwrite, or maybe 3 hours to take it, to underwrite a file. So actually, our underwriters take that time to give you that upfront. You say, okay, this is what we need in order for us to go ahead and get this loan going.
Sure. So in your opinion, and at least in my opinion, which one is better? Pre-approval is better to have, or a pre-qualification is better to have when somebody wants to go out shop for a home?
See, it all depends on the consumer, if you ask me, in my experience, right? Let's say if I'm in the market of buying a home and I don't want you to run my credit because I don't know when I'm going to buy. Either I'm going to buy in 30 days or I'm going to buy in 6 months, right? So a lot of consumer gets into pushback that, okay, I don't want you to run my credit. This is what I make, just give me something that I qualify. That's fine. That's pre-qualification without running your credit. Now, when I interview my clients, we talk about the plan. How long it's probably going to take you. You can see a home today and you can put an offer. Might take you 6 months. So it all depends. In my opinion, if customer is okay to run the credit and they want to buy within the next 4 months, because the credit is good in my system for 4 months, right? Once I run your credit. So then I highly recommend scenarios that if you are a little skeptical, oh, my loan might not go through, if there's a problem with the credit or income, then it's a better idea to get that approval so that we know upfront and get you more confident.
Sure. And how much generally you touched a little bit on that people are a little bit skeptical to run the credit reports, right? Mm-hmm. So in your opinion, how much impact, I know you're not a credit score, what you call the expert, but just in your opinion, from whatever you have seen in your practice, how much impact does it make on the credit score of people when you run a credit report for a mortgage purposes?
I get that question all the time. So here's what I tell them. Anytime you run your credit for a mortgage, it's a full-on credit check, right? That can reduce 20 to 25 points right off the bat from your credit report when it's going to be run again, right? So let's say you are in the market. Within the first 30 days, you can go and shop. Let's say you go buy a car. You just don't go to one dealership. You go to a couple of dealerships and try to get a good deal. Same thing with mortgages. You are just not going to go to your primary bank and apply for the loan and boom, you got the loan. No, you're probably going to shop around because this is going to be your biggest purchase, right? In your lifetime, this is the biggest purchase. So within 30 days, if you run your credit, it's okay. The credit bureaus already know that you're shopping around, so they don't ding you as much. It's only counted as a single inquiry. But then again, if you run your credit multiple times of different products, then it affects the credit even more.
So the way I'm hearing you saying is that within first 30 days, if a client is shopping on different banks, credit unions, mortgage loan brokers, for the same purpose of picking up a mortgage or shopping up for a mortgage, the impact on credit score is not much because he's shopping for the same reason.
That is correct. Because the first single inquiry, let's say if it drops your 20 points, you can run your credit 29 more times. And given the 30 days, it will still be 20 points. They're not going to ding you on every single inquiry from mortgage.
Okay. All right. And for how long this pre-approval or pre-qualification is valid for, Nathan?
Well, our upfront approval is valid for 4 months. So once I run your credit and I get you an upfront approval, it's good in my system in about 4 months. Typically, 3 months. Typically, if I'm talking on the lender wise, it all depends. But even if it's 90 days, and let's say I'll give you my example. Let's say 4 months your credit is secured with me, right? Now you don't get into a contract for the first 3 months. Now we have 30 days left when the credit's going to expire. Let's say you get in the middle of the 4th month, you get into a contract. By the time we're going to close the file, the credit's going to be expiring. So we have to rerun the credit. So I say about 3 months should be the point where you should be ready to buy the house, because I can close the transaction in 21 days. So, but I let them know. So it's good for 4 months.
Okay, wonderful. Thanks, Nathan. Guys on the audience, anybody have a question?
Yeah, I have a question. This is Banu here.
Sure. Hi, Banu.
Yeah, so whenever we are investing on a property, usually they say 20%, is a good amount, because otherwise you have to pay for the PMI, right? But that's because of this COVID-19, I mean, we don't know, like H1Bs, their jobs, we don't know like how the situation will be next year. Right. So is it good to still invest 20%, or is it wise to keep like 10% down and invest in some property?
Well, that's a good question. I've been getting, because primarily who I deal with is my majority of my clients are from H1B visas. Okay. So I've been getting all these questions where should I just put 10% down? Should I just put 15% down? It's a good idea to have some cash in hand. Don't put all the way 20% because you're definitely going to pay PMI. But lenders have so many companies out there for cheaper PMI. So even if you, let's say, paying $150 a month for the PMI, and that can work it, just put 10.01% down so that you don't have to impound your taxes and insurance. That's also, you can save money. So yeah, it's a good idea to put 10 to 15% down if you are okay with the PMI. It all depends on what type of loan, what's the dollar amount of the loan. There are so many, such a huge competition between these PMI companies that every lender, go for the cheaper PMI.
Okay, thank you. And also, if we already like invested in a property and it will take 6 months for the construction, right? Meanwhile, if something happens, then is there any way that we can get the money back, the contract money, the initial money that you put in the contract?
So that would be a question for I would say the builder, how the contract is written. I do have a client right now, I'll give you an example, who is in the contract and they want us to basically lock in the rate. But if anything comes in the market, they are not getting the deposit back. That's my, current that I'm dealing with. But again, that will be something how the contract is written, that during those 6 months, if you want to back out, they might charge you a penalty. So I'm not sure how the contract is written.
I can also expand a little bit on that question, Nitin. So Bhanu, before I try to answer that question, when you say construction, you mean you are in a contract with the builder, or you are doing a new construction?
Yeah, new construction. I'm in contract with the builder. Yeah, of course.
Okay, so builder is doing the new construction and you are purchasing a new home from the builder. Is that correct?
Yeah.
Okay, and which state you are in, Bhanu?
Texas.
Texas. Okay. So a couple of things which have happened during this COVID-19, and you may want to definitely check with your builder. And are you working with any agent, or are you directly working with the builder?
I'm working directly with the builder, but
Okay.
I have an agent, but he's just like a sleeping partner. I mean, he just don't do anything. It's all my decision. I just use his name as a realtor just to get that 3% cash back, most of it.
Sure. So you might want to wake him up a little bit and ask him to go do a research and see if from the statewide Texas perspective, if the state have come up with some guidelines that if a person loses his income while they are in the middle of the transaction and the person loses his income due to COVID-19, there might be specific measures which your state might have put in place based on which you might do a rollback of your transaction and get your deposit money back.
Okay.
So different states have come up with different measures. For example, in California, even in the middle of the transaction, if my buyer loses income, or even if he loses part of his deposit, for example, he was coming up with his down payment from his stocks, for example, right? And the stock market just declined and he cannot come up with down payment now because he couldn't get it out from his stocks. I can go back and I can roll back his transaction and get every single penny back to him if something happened because of the current situation.
Okay. Yeah, sounds good. Thank you.
So did I answer that question? So you may want to check your current guidelines from your state and talk to your agent and builder and make sure they understand that there are different ways in which they can get you out of the contract.
Yeah. Okay. Thank you.
Okay. Any other questions guys have on the audience?
Well, hey, hi, this is Prashant.
Hello, Prashant. Please go ahead.
Yeah, well, I'm a software developer with I'm on H1B right now. So we are a group of like 3 to 4 people friends. So this is our first investment, I could say. So we are trying to plan to take some property and do some like for the giving for tenants or something, like we are planning to do that, like as a first investment. So I'm on H1B with 700 of credit score. So is that the down payment? How much should be the down payment would be for the property worth of 300K, and which state would be the better place to invest? For second question. And being on my H1B, and I'm just, as I tell us, so this is my first investment. I just have a credit limit of like $10,000 to $15,000. So, is how will be the approval chances? And the final question is like, since we are a group of people taking together with like as a partnership, the person who is being on the name of the loan should be the in the registration or on the name of the house. That's my question.
Okay, so let me dissect the questions a little bit, and we'll take them one at a time, Prashant. Is that okay?
Okay, sure.
So your first question was, being a first-time investor, you are a group of people who are pooling up money and looking at an investment of about 300 to 350K.
Yes.
And your first question is, what is the right amount of down payment in your opinion, with which, what is the right amount of down payment with which you are going to start seeing positive cash flows? Is that the right question?
Yes.
Okay, Nitin, go ahead, please.
So, and what state are we talking? California?
I'm not specifically restricted to any state. I'm open for any other state. So I'm just looking for investment. Yeah.
Got it. So
So
typically,
Nitin, maybe you can handle the money part question, and then I can handle out I can handle up the state part question. What states are good enough for investment in today's market?
I was going to tell you that he will take the investing part. I'll take the money part. Typically, lender wants 25% down payment on an investment property purchase. Okay, that's the normal norm. Again, if you want to put 30% down, it's going to decrease your loan to value. That's gonna get you a good rate as well. So minimum down payment is about 25%, typically, for an investment property.
And Nitin, the other question from Prashant was, how much credit score do they need as a group? Do you look at the credit score as a group? Do you look at the credit score as one person when they're applying as co-borrowers? How does it all work?
Well, if they are 3-4 partners, let's say, and they are pooling money, so it basically who's going to be the primary and the secondary on the loan, right? So let's say 2 people are investing money and they both going to be on the credit. So now typically the norm is the standard is about 740 above credit score will get you a good rate. Higher the credit, lower the interest rate. That's always been the norm. I've seen lenders doing 680 for an investment property. Golden One does 720 for an investment property. So different lenders have different requirements, but normal norm is 740 and above. That can get you a decent rate.
And
okay, wonderful.
this one, I have a question. Is speaking of the credit numbers, is 720, is that normal for even not an investment purchase, but a normal house purchase?
Right. I mean, I have seen lender does loan on a 580 credit score.
Got it.
Right. And some lenders, they have minimum requirements for 680. So let's say if you, for an example, if you go with an FHA program, all you're required to have a 580 score from FHA, right? But some lenders don't take 580. Like Golden One will do your loan for FHA for 640 credit score.
Got it.
Right. So it all depends. There is a standard. It used to be 10 years ago, okay, 720, 740 is the normal norm. That, okay, that's going to be the credit score, and then you're going to get a good rate. So nowadays, it's all, banks have their own guidelines and process. You know what I mean?
Got it.
It all depends.
Yeah, the higher credit score you have, the better rate you get. So because the less risky borrower you are.
Exactly.
Are there any cases does the seller would accept with a zero down payment or something based on the credit score?
Well, zero down payment is typically not, I mean, it's not in trend anymore, if you ask me. Yes, there are programs out there that allows you to have 0% down. You can get, federally governed loans for the down payment assistance program. But according to me, you end up paying a little bit more. But again, that solves your purpose to own an American dream, right? So it's just situation after situation. Let's say I have money for reserves, but I don't have money for the down payment. There are lenders out there who will get you the Fed's money for your down payment.
Okay.
So there are programs out there. Yes.
Okay. Thank you.
Yeah, so if I can pinch into that question a little bit and explain it a little bit further, Prashant. So from the seller perspective, it's not a problem whether you are putting 0% or not, because seller is going to get his entire money at the end of the sale. Right? So seller is not really interested whether you are putting 0% or 10% or 30% or 40%, unless you are in really competitive markets, then absolutely it makes difference.
Okay.
The person who should be considering that, or the right question, or the right person whom you should be asking that question is the lender. That will lender approve your request for an investment funding with 0% down?
Okay.
Remember, the moment lender hears, and I apologize, Nitin, I don't want to I don't want to be very strong, but the moment lenders will hear that, hey, you are asking money for investment, the moment they figure out that you are going to make money, they are also going to make money off of you, because they are in the business.
Very true. Very true.
Yeah. So the moment you say 0% and you say, hey, I'm going to put an investment property, but I don't have any money to put down, then it raises a red flag for them. You know what I mean?
Got it.
Yeah. So did we, okay. And your last question was around the states, what states might be good places to invest right now, right? So a couple of states, the way I think about it, and I get this question asked many, many times, that, hey, what are the right states to invest in? So first of all, you need to figure out, when you talk about investment, that what is your mindset from investment? What are you planning to do from the investment perspective, right? So there are two directions in which you can think. One is, when you invest, are you looking at your increased equity from your investment? Is that what you are after? That, hey, I'm going to invest 300K today, and then after 7 years down the line, my investment is going to grow to 800K, and I'm going to make 500K in equity. Is that your primary aim? Or your primary aim is to get a rental income, passive rental income month over month?
Second one, passive rental income.
That is correct. So that is the first question you have to ask yourself, and you have to be very clear as to what is your primary aim for your investment. And based on that, then it makes sense for us to figure out what states are good for you.
Okay.
Because both the things don't come together. You cannot say that I want to have the maximum equity gain also, and I want to have the maximum rent also. Those sort of properties we still have to build.
Yeah. So I'm going with I'm looking for like a passive income for the rentals.
Right. So as far as passive income for the rentals are concerned, you should be looking at states where there is a constant influx of baby boomers. So this year alone, I forgot how many baby boomers were getting into retirement. But most of the baby boomers, when they get into retirement, there are 4 or 5 different destinations which they go to. And it's correct across United States. For example, Utah is one, Florida is another one. And there are a couple of others. I have a list of them. And then those are the states which you should be looking at, so that your rental income is always there. You know what I mean?
Yeah.
So did we answer all your questions, or did I miss any of them?
Perfect.
Thank you.
Okay. All right. Any other questions anybody have on the call? All right. So Nitin, in that question before this, you were talking something about PMI and all those things, right? So for the benefit of the audience here, can you explain us what is PMI?
PMI is basically known as private mortgage insurance. So what it means is, anytime a consumer pays less than 20% down payment, they are subject to a PMI. That is basically assuring the mortgage lender that, okay, if they default on payments, there's a backup plan. So that's mainly it. So let's say you are in the market and you cannot afford 20%. Yes, there will be a PMI. It used to be really high. You know, it depends. And it could be cheaper, and it will make a lot more sense for some buyers to pay a little bit PMI and not pay 20% down, right? If you have one borrower with one income, it's going to be a little bit higher PMI because we are dealing with only one income, right? If we have 2 borrowers, the PMI is going to be cheaper because we are dealing with 2 incomes. So primarily, it's basically whoever pays less than 20% down, they are subject to a PMI. Again, some lenders include that in the interest rates. They don't charge anything on top of your, even let's say, in some lenders where you can pay 10% down and no PMI because they will be adjusting the rate. So they will include it in the rate. So there are options as well.
Okay, okay, all right.
You can pay upfront PMI. You can pay off your PMI upfront and not have a single payment. It all depends on scenario to scenario.
All right. So the way to put it in a couple of lines is PMI is the insurance which a borrower is paying to offset the risk of the lender. Is that correct?
That's correct. That's correct.
All right, wonderful. Any other questions on the call?
Yeah, I have a question, Banu, again. So I have a property and I invested 20% in it. It's my primary residence. I bought another house. So can I use that equity that I built? My property has been grown, I mean, in this last 1 year. Can I use that equity to the loan of my second house?
So your question is, if you want to take some money out of your primary home and
Yeah.
put it into your investment home and pay off the balance.
Yeah.
Absolutely. If you
So
are,
is it on the 20% that I already invested, or I can also take the money? The price has been grown, right? I mean, if I did the appraisal now, the price has been increased by at least 50K. So that 50K also, can I use this as a loan?
so now, okay. So now the question is, you are into 80%, you have loan to value right now. Typically, lenders want to see 75% loan to value to consider something called cash out refinance, right? Or you can go ahead and get an equity line of credit, which also requires you to have at least 70% loan to value. So let's say you gain 50,000 on your property. Does that make your loan to value at 75%? If it makes it 75%, you do qualify for a cash out refinance since the rates are low, right? Or if you are at 70% loan to value, you can definitely take a home equity line of credit and you can do whatever you want with it. You can pay off your investment property if you want, or you can invest or buy another home. But you have to be at a certain level of mortgage.
Okay. And yeah, sorry, but I don't know what is this loan to value exactly.
So loan to value is basically, let's say you buy a property for $1 million and you pay 20% down. So you own 20% of your property, right? 80% you still are out there that you owe. So 20% is your own money. That's your equity in your home. The higher the value, the LTV would go down, which is loan to value. So you have to be at 75% loan to value currently to apply for either a home equity line of credit. So you can take that 80% of your 50,000 as an equity out and pay down the balance.
Okay. And the interest that you pay on the equity, so are you gonna gain it, or is the lender gonna? The bank gonna get the interest? Like how does that work?
So let's say you have a loan with, I'll give you an example. Let's say you have a loan with Wells Fargo and now you go to Bank of America to get the equity line of credit. That's going to be opening up a second mortgage on your first mortgage, right? Now you're going to have two mortgages. You follow me? Hello, Banu?
Yeah. Okay. Yeah. The signal was a little bit bad, but yeah, I get it. Okay. No worries. Thank you.
Nitin, we can't hear you. Sorry. Give me a second.
We cannot hear you?
Yeah, we can hear you now.
Oh, what happened? Oh, so again, you will definitely pay whoever you get the HELOC from. Let's say you are at 70% loan to value, and now you opened up a $50,000 line of credit with Bank of America. It's usually going to be 10, 15 years interest only. So you will pay that payment to Bank of America. That has nothing to do with your first mortgage. We are just adding on a second mortgage onto your property.
Okay. Yeah. Thank you. Makes sense.
No problem.
All right. Any other questions? Nirav, you have any questions? Ashima, Suhas?
No, I'm good. Thank you.
Wonderful. Okay. Karen, do you have any other questions who got asked offline from you?
Yes, I have more questions here, Sharad.
Yeah.
Right. Nitin, what's the difference between a fixed rate mortgage versus ARM?
Oh, okay, so ARM. So 30-year mortgage, it's basically a fixed rate mortgage, has the same interest rate from the time you have taken the loan. That's 30-year fixed mortgage. You're never going to change in 30 years, right? Whereas ARM products, which is are good for 5, 7, and 10. So what it means is with the adjustable rate, you will have a fixed rate for 5 years or 7 years or 10 years, whatever term you use or choose, but it's still going to be amortized for 30 years. So it's basically bank is saying, I'm going to qualify you for 7-1 ARM or 10-1 ARM or 5-1. 5 years, you will have a set interest rate, let's say 2.5%. After 5 years, you will have an option of basically refinancing either to a 15-year term, 30-year term, but it's good for 5 years. After that, the rate's going to change. So it's variable rate. So normally what a lender does, it's they qualify you at a higher rate if you want to go ARM product. They will add the index and our internal jargon. And then as compared to 30 years, it's just a fixed rate, let's say 3%, 3.5%, and it's good for 30 years. That is mainly the main difference. Yeah.
Right.
What does ARM stands for, Nitin? Is that like my arm, or what does it stand for?
Adjustable
I was
rate.
about to ask that.
It's called adjustable rate mortgage. It adjusts after 5 years or 7 years or 10 years.
Okay. All right.
I got a question for Nathan.
Yeah, hi.
I got a question. Yeah, I got a question, because Carlos. Nathan, if when you mean, is there something like a 7-year fix? Like a 7, like it's fixed for 5 years or 7 years instead of just 30 years? Can somebody get a 5-1 instead of being an ARM? Can it be an ARM but fixed at the same time? For example, if somebody just gets a fix like a 7-1, for example, maybe they're working there for a couple of years. They don't want to be there for a 30-year fix. They're going to move anyways. They're buying a house for their job, and they're going to go to a different location. So they really have to lock themselves in a 30-year. If they're only going to be there for a couple of years, can they get a loan that's only maybe fixed for a couple of years, and maybe because it's fixed for X amount of time, possibly get a lower rate?
Well, that is the whole idea behind it. Is, let's say when I interview my customers, right, I ask them, how long are you planning on staying there, right? Typically, if you ask me, everybody refinances. Even if they want to go with 30-year fixed first, you will see a norm of basically between 5 to 7, about 8 year.
That's a cycle. The cycle's roughly around 5 to 7 years.
Right. Typically they refinance, right? So it cannot be fixed for 5 years. It's basically the payment's going to be sky high. If you want to go 5 years.
Yeah. So Nitin, let me interrupt a little bit. Let's define what is fixed rate we are talking about, right? So I think the way if I understand fixed, and Nitin, you can correct me if I'm wrong.
Mm-hmm.
When we talk about fixed rates, we are talking about the interest rates which are fixed, not the length of the loan. So
Right.
let us say, for example, you borrow $30 from the bank to buy a home. The loan is amortized for 30 years, which means you will end up paying $1 per year back to the bank for the next 30 years.
Right.
But the interest rate which you will pay on that loan will be fixed for 5 years.
Right.
Only the interest rate will change.
That's correct.
Versus when you say 5-year fixed loan, which means you want to repay $30 back in 5 years, which means every year instead of owing back $1 to the bank, you will owe $6 back to the bank.
That's correct. Because that's why there's no 5-year fixed, there's no 7-year fixed, there's no 10-year fixed. There's 15-year fixed, and there's 30-year fixed. So let's say, Carlos, if you are buying a home and you want something fixed for 5 years, absolutely.
But amortize to 30 though. But amortize to 30.
Right. You don't want to amortize it in 5 years.
No, amortize it to 30.
Right. So you will get the fixed rate for the first 5 years.
Is that considered an ARM? Would that be an ARM?
Yes, that will be an ARM product.
So it's fixed only for 5 years.
And then it changes.
Okay. And on those type of loans, do you get a lower interest rate?
Yes.
Or you do?
Yes.
So would it benefit somebody that's not going to be there more than 5 years to get maybe a 5-1 ARM?
Oh, absolutely. I mean, majority of my clients, they want to go ARM.
That was my question. Yeah, you answered my question. Yeah, thank you.
So they definitely want to go ARM because their goal is to basically just keep on building the equity and paying the lowest interest rates.
Right.
Yeah. So yeah.
Yeah, unless you want to unless you want to die in the home which you purchased for the next 30 years. In my opinion, generally the refinance cycle is just like Nitin said, it's about 7 to 8 years. So people refinance every 7 to 8 years.
Right.
So ARM is a perfect product.
Yeah. So that would be a benefit of somebody that maybe needs that lower interest rate to qualify to get into the home. And you just mentioned that they refinance anyways. So at least that would be a good entry level getting in to get the house, because obviously the 30-year fix, it's fixed for 30 years. Obviously the rate's a little higher. Maybe having that lower interest rate might benefit going into that first, and then just to get into the house.
Exactly. Right now, what I'm seeing is a lot of customers are refinancing for either 15 or 30 because the rate was so low. 2 months ago, I was locking consumers in is an unbelievable rate. So it will not make any sense for you to go with the 7/1 ARM product at the same rate as 30-year fixed. I'd rather go 30-year fixed because I'm getting the same rate. Even if I want to refinance in future, who cares, right? You're still getting the same rate for 7/1 and 30 years. So it all depends on the market as well.
Right.
Right now, ARM rates are great for new purchases.
Thank you.
Modern One's rate is 2.75.
Thank you,
So,
Dan.
Wonderful. Thanks, Nitin. Any other questions from audience? All right, Karen, I'll give it back to you to move on with your questions.
Sure, thank you. I have here another question, Nitin. What is the difference between various lenders, for example, credit unions and banks?
Good question. Since I'm
So
working.
let me repeat the question. The question was, what is the difference between credit unions and banks? Was that the question, Karen?
That's right, from various lenders. Mm-hmm.
Okay, all right. Go ahead, Nitin, please.
It's a huge difference. It's a huge difference when I say compare between credit unions and banks. You have to look at it this way. Banks have shareholders. Credit unions do not have shareholders, right? At the end of the day, bank has shareholders to pay out. Credit unions are not for profit. So we don't have any shareholders to pay whatever money we make, right? So what credit unions normally does, they give it back to the members as compared to a big bank, right? It's more member-based. It's more one-on-one service. The main difference between a credit union, it's more community-driven. Credit unions are known to be very, community-driven and stuff like that. So the main difference between would be shareholders and non-shareholders. We are not for profit. So whatever profit we make, what credit union does is they give it back to a consumer as lowest interest rates, no fee on a checking account, right? Lower interest rates on your personal loans, lower interest rates on your credit cards, home equity lines, auto loans. Compared to a typical bank, they are there to make basically a profit from you. If they don't make a profit from a consumer, how are they going to pay their shareholders? So that's the main difference.
So as far as the bottom line is concerned, from the consumer perspective, when they are looking for a home mortgage, there are better chances that they might get a better terms on their interest and other terms on a home loan from credit union versus compared to banks. Is that correct?
Absolutely.
Wonderful. And I've also heard, Nitin, about these mortgage brokers, and I'm pretty sure other people on the call might have heard about them. So where do they fit in all this bigger picture when talking about the home mortgage?
Well, if you go into the private sector of being a broker independently owned, you have access to a lot of lenders, right? You have access to a lot of lenders. Let's say number one doesn't want to take your loan, you can go to number two, number three, number four. Compared to as banks and credit unions, we are going to underwrite the loan with Golden One guidelines, or we're going to underwrite the loan with Bank of America guidelines, right? Private lenders, they don't offer the same products and services that a typical bank or a credit union can offer. They are only there for your mortgage or second mortgage or refinancing, or probably, nowadays, home equity line of credit. It depends. So you will have much more larger chances of getting decent products and services from a bank and a credit union as compared to a private lender.
Okay, so from a consumer perspective, what will your suggestion be? Like, just like we talked about upfront, that since this is one of the largest purchases of anybody's life cycle, I'm pretty sure I always encourage my clients to shop around and check where they are getting the best deals. So what will your recommendation will be? Since we talked about banks, we talked about credit unions, we talked about lenders, what will your recommendation be? Where should people check out for their mortgages?
They should check out all three, to be very honest. That's what I think. And the reason I say is, let's say you walk into a typical bank, right? They're going to offer you relationship pricing, right? That's huge, right? Whereas compared to credit union, you walk into a credit union, they are more member focused. We are open to exceptions. We are open to taking that jumbo loan and portfolioing it rather than selling it out when you sign, right? Mortgage lenders, they have access to a lot of other different lenders. They work with you on one-on-one like a credit union can to understand your situation. Where a typical bank will have a credit requirement, right? Because they have the stick one guideline, 720 score, they won't be able to, right? They cannot make an exception. So now let's say this customer comes to credit union and they have a little bit less credit score, but they have more assets to show, right? Overall picture, not the relationship, just the assets to show. We can make an exception based on the transaction. Now, let's go to your private lender. Let's say you have a credit issues. Private lender will have variety of other lenders out there that can take you, let's say, on a 580 score or a 600 score or 620 score. But guess what? The rate's going to be a little bit higher, right? So that's the main difference. You should check out all three based on your scenario, where you're coming from, and see what the best work for you, right? Credit unions are more focused towards your needs, same as banks and other lenders as well. You should definitely check out all three. Definitely.
Absolutely, absolutely. Thank you, Nitin, for that. And do anybody else have any question before I will ask one last question and then we'll land the plane? Anybody on the call? Any other questions? Bhanu, Nirav, Prashant, Ashima, Suhas, Swami, Carlos?
Yeah.
All right, wonderful. So I'll take one last question, Nitin, and this is a question I get asked many times, especially from our community on homies and lots of other groups I am part of where we have migrants from India. Okay. Home buying is one of the top things on our mind always. That's something which we'll live for, right? For almost half of our lives. Great. Yeah. So most of the times I get question is that, hey, Sharad, I'm on H-1B and most of the people are on visas here, right? Or I'm on L-1 visa, or I'm on green card. I'm not a permanent resident of the country yet. Can you shed some light on what sort of different loan programs or what sort of different loan options people have when they're in one visa category versus another? That was my first question. And the second question is, according to you, are there any differences as far as when a person is on visa versus when they're a permanent resident of the country? Do you see any impact on their qualification or their interest rates, Nitin?
Absolutely. To answer your first question, there are a lot of different programs out there for H-1B visa holders, L1 visa holders, and green card holders. So green card is basically you are a lawful, permanent, legal resident. So to answer your question, yes, quite a lot of different lenders, banks, credit unions have special financing available for H-1B visa holders. I have seen a lot of H-1B visas coming with 10% down payment, 5% down payment, just to get into the house and build equity. One program is very popular, you might know, it's called 90-10 financing one loan, or you can go 80-10-10 to get rid of the PMI. So that's a very unique product especially for H-1B visas where they have 10% down payment. They don't want to pay the PMI. So what a lender does is, or Golden One does. We open one loan for 80%, a HELOC for your 10%, and 10% is your down payment so that we can get rid of your PMI, right? That's one program. We do have programs for H-1B, L-11 where you can qualify for 3% down payment up to 20%. Now, to answer your second question, what is the main difference between H-1B and the green card? It's all about income. H-1B, you are contracted, right? A lender will need at least a 2 years expiration on your H-1B visa. What happens after 2 years? Well, during this crisis, people are very uncertain what their employer is going to do. I've been hearing, I've been reading blogs and all of that. H-1B visa might get affected in future if this whole virtual thing, it's going to continue and it's going to perform, right? So compared to as a green card, you are a permanent resident, you have a job, right? There's no risk of basically, okay, your contract is over, you can go back. You're not going to renew your contract.
Well, there is no guarantee for job even if you are green card. So
right, exactly, yeah. It is. But there's stability.
Right.
You know what I mean?
At least they can catch you.
Exactly. If you're going to get, how you're going to afford the mortgage? It all depends, right? But yes, H-1B visas are looked at very carefully. We look at the contracts, we look at everything as compared to a green card holder. Let's say you've been working for Apple for 2 years on a green card, you happen to get laid off, absolutely you're going to get a new job because you have expenses, or you don't have that much option to basically, okay, my visa is over, I'm going to go back to my country and work there, right? So that's how the lender looks at it.
Okay. So in terms of the bottom line, for example, interest rates and down payment, do you see any differences in your day-to-day practice between H-1B visas versus green card? Is there a benefit one to other?
A huge benefit. I don't say there's a difference. It's the same thing, because whether you look at it, the green card as a lawful resident, and then you already have, let's say, a 5-year work permit all ready to go for 5 years, we can't discriminate, right? We cannot pick and choose, right? So we have to give the same level of service and products and services, whatever we're giving to an H-1B visa compared to as a green card. So it all depends on transaction, So both of them are okay. I should not say, oh, green card is better than H-1B. No, majority of my clients, like I said in the beginning, are H-1B visa holders. I would say 80 to 90% of my clients are H-1B in this area. So no, I don't see any main difference as compared to just job stability and the visa being expired. That's it.
Okay. Wonderful. So I think we are on top of the hour. So I'd like to land the plane now, and I'll go around for any last minute questions from people around here. Swami, Bhanu, Neerav, Prashant, Carlos, Ashima, Suhas, and Feifei. Anybody on the call? Any last minute questions before we wrap up the call?
Perfect. Either I did a good job or either I just...
You did a great job. We had a great time.
No, if you have any questions, feel free. Sharad can share my information, or I can. Any lending questions going forward, definitely let me know. Any help I could be, I'll be honored.
Absolutely. And I hope we brought value to everybody's time here. Sorry, Carlos, you had some question?
Yeah, Nate, so if another question arises later that we didn't get to ask you, we can just contact you guys, right? We can just contact you.
Absolutely.
Yes.
Okay.
So people who like the session, just boost our morale a little bit, say good session on the chat. So we know you guys liked it. We are bringing value to your time. And going forward, I'm going to bring few other guests on this session. So we talked about loan, we talked about real estate, and going forward, I'm going to bring a couple of special guests around how now you are using other people's money, you have built some assets. Now there got to be a way to protect those assets too, from lenders, from creditors, specifically if we run into some similar situations going forward. So watch out for sessions going forward where we will talk about how to protect those assets. And thank you so much, everybody, for joining the call. I look forward to speaking with you next week.
Thank you so much, Sharad, for having me. I really appreciate it. Have a great day. Thank you.
Thank you. Bye-bye.
Thanks, guys. Bye-bye.
Thank you. Bye-bye.